This is a screaming red alert buy signal. The high-risk growth portfolio returned 233% in 2021, turning every $10,000 invested into $33,000. And 2022 is already off to an amazing start, up 15% total return in the first few trading days of January. If you're on a free trial, our trade alert is to put $10,000 to work today. Currently, you'd be buying 79 shares of UVXY, the ultimate crash insurance, 198 shares of our favorite growth asset, tech, ETHE Ethereum, that's the Grayscale Trust. Then we need a hedge against inflation, which is out of control. 89 shares of BOIL, and boy, has this been boiling up for us. Currently, the position is 31% of the portfolio. So again, it costs $10,000 to get this to work. And if you'd like a custom screenshot for a different amount of money, just reach out to Dean Gallagher and he can do that for you. I'll have his info on the screen shortly. Now, a few days ago, we were saying the bond market was at a critical crash level and that this was causing the NASDAQ, Bitcoin, Ethereum to have volatility to the downside. We predicted that this would not go any further, and sure enough, as the bond market has begun to recover, tech positions are screaming higher, especially Ethereum. So that's really what we were focused on and will continue to be focused on for the remainder of the year. Focus on the bonds, bet big on the inflation. That's what we're recommending to our clients. So again, if the Fed does not protect the bond market, the entire global stock market will collapse. China's firing up the money printing presses. Alibaba is jumping higher. In our core strategy, emerging markets is finally kicking ass, outperforming US stocks by many multiples. And it looks like we're going to see inflation peak out by March, which could slow how fast the Federal Reserve hikes interest rates. Any dovish surprise will be very bullish for assets we're invested in. Let's take a look at the portfolio builder track record. Our safe growth strategy, where we recommend you keep 70% of your money, is up 25% in 2021, and it's already jumped up 7% in January. The high risk strategy is currently up 15% in January. We recommend rebalancing each month. Let's say your high risk strategy literally doubled in a single month, which we have had happen. Well, you'd cut that in half, put it into our safe growth strategy, and then let the high risk strategy keep on rolling. That's the general strategy. So what are the key macros to focus on in 2022? The most important fact is that McConnell gave the Democrats $2.5 trillion to spend by allowing them to increase the debt ceiling. That's really all that matters. Now all they have to do is figure out how to spend it. If we look at this chart and look at the surplus or deficit of the US government, the last time we ran a surplus, which is where we spend less than we make as a country, was in 2001, and you get a 2-year stock crash. Guess what? The jokers in control of the government will never do that again in your lifetime. Not unless something dramatic changes in terms of who controls the spending. So now all they need to do is agree on how to spend it. I actually think they're going to give out more stimulus checks and pull this off before April. Otherwise, the economy is looking at a very sharp fiscal cliff and people are refusing to go back to work. In fact, a good 4 million people have decided to retire and live on increased savings, increased value in their stock portfolio, and increased value in their home. So they're just borrowing and chilling out. This is going to be a problem. Meanwhile, we have trillions in corporate stock buybacks. The low December labor growth is likely to stay low until March, and that's due to this new variant scaring people. It's funny to watch the authorities backtrack and completely change the whole narrative on this. So it looks like we're ready for a grand reopening, at least in the US. If we look at Canada, Germany, New Zealand, Australia, they are doubling and tripling down on this lockdown nonsense. So we'll have to keep a close eye on that. But in the US, at least, I'm predicting no more lockdowns. Let's get back to work. So if we look at the options for where to park money or capital, cash remains trash. Governments are devaluing their currencies by trillions a year. And that is a global phenomenon. Bonds are still relatively negative in terms of real return. So I like bonds after they break through the levels we saw last March. And until then, I'd rather bet on growth assets if I believe bond yields are going to temporarily fall, which is exactly what I'm predicting until they pass Build Back Better. So our growth assets are likely going to do very well. Now, what's really fun is we're actually seeing our value and growth assets scream higher together. So you're getting the best of both worlds right now. So cash is trash, bonds are garbage. Investors have no other logical option of where to invest money. We're bullish right now on stocks, crypto, commodities. I believe they will melt up until bonds become too attractive. Now, the catch is the inflation and a strong labor market recovery will expedite the bond crash to the point where they do become attractive. So these are the key market threats. Now, I'm expecting the PPI and CPI to stop rising by March and then to begin falling. And if this is the case, the Fed can do far less damage to the economy than most people are anticipating at this moment in time. And that's why we still remain in a 2-to-1 ratio where we're heavier in growth assets relative to value. So as soon as we get the Build Back Better bill and a better idea of this inflation, we can start to make decisions on the right asset allocation. Now, it's important that you watch my webinar every Monday, Wednesday, Friday, so you're on top of this data as it comes in. We'll look at that CPI print today, which did come in right at expectations. So because it wasn't beyond the expectations, the market loved it. And we've got some funny cartoons to make fun of the Fed. 7% inflation, and they're going to try to hike rates 25 basis points to kill it. What a joke. I've got a great comic for you to laugh at that, which is what the market's doing right now, laughing at the Federal Reserve. Now, if anything goes haywire, we get a black swan, something I didn't anticipate goes wrong. Our clients sleep like a baby at night because they own the VIX, UVXY. It's basically a highly leveraged out of the money put option on the S&P 500 that automatically rebalances itself. It loses a good 2% a week just from the cost to maintain the position. But it's beautiful. When stocks really freak out, UVXY skyrockets up. And in March of the great lockdown, you can see it went up 1,100%. So if you had 10% of your portfolio long the UVXY, and something epic happens to the downside, you have nothing to worry about. You're completely protected. And right now we're just slightly above that 10% level. So our clients can indeed sleep like babies. Now may be the best time ever to follow our high risk growth and safe growth portfolio. Now on the free trial, you're only going to get the high risk strategy. Remember, the whole system's designed to pull profits off the high risk and then stack it into your safe growth strategy. And that's when the high risk is going up in value. On the other hand, let's say we have a volatility event that hurts the value of the high risk portfolio. Well, then you're going to pull money out of your safe growth strategy and refill the tank in the high risk. So that's why you really want to upgrade your free trial as soon as possible. Now, I believe we're entering a 5-year growth to value rotation cycle that will be dominant in energy companies. We've greatly underinvested in energy and have had this fanatical obsession about green energy. All that's done is created energy shortages across Europe in a time of inflation. And boy, oh boy, are they paying the price today. So we're betting big on good old school energy products. We recently took a big profit on our oil play, and now we've rotated into natural gas. And I'll show you that's outperforming the oil play 3-to-1 since we made that trade. Now, the cycle's likely to last 5 to 7 years. It's going to be volatile. It's going to be bumpy. It's not going to go straight up. But in general, that's what we're anticipating, a 5 to 7 year cycle of inflation that forces the Federal Reserve to hike interest rates until they break the whole damn thing. And that's exactly how we're going to play this market. Now, here's our strategy in one screenshot. So essentially, we believe that there's really two main markets to focus on. One is growth or technology, which again, we're weighted 2 times in compared to value currently. And so we basket together the NASDAQ with the triple Q, as well as Bitcoin and Ethereum, both technology, both highly sensitive to rising interest rates. Now, in March of last year, I want you to see, right when they passed stimulus early in the year, Trump with $1 trillion in December, Biden with $2 trillion in early February, we had growth and value go up together. The growth is the candlestick and the value is the green line. Now, interest rates are yellow. Now, look what happened when those interest rates spiraled out of control. The tech stocks got crushed, as well as Bitcoin, and your energy companies or the value sector of your portfolio went screaming up. So in general, the value protects your growth, and then the VIX protects your value. And so combined, it's a very strong strategy. Now, what happened? The rest of the year, rates fell, all sorts of problems arrived, and energy traded flat, came back down, and the tech sector came screaming back up. And that's what I'm expecting right now, is for rates to stabilize for the time being until we pass a new aggressive spending package. And then expect the next painful move in interest rates. So that's our hypothesis for the markets in a nutshell. If you want to get the full scoop, call Dean at 505-322-7515. And don't forget, we only have 3 spots available per day at special pricing. We actually have a deal that can give you a lifetime package, 1 fee, and you gain access to these webinars for the rest of your life, as well as the software platform to issue your trade alerts and a whole lot more. So call Dean at 505-322-7515 to get all set up. Okay, I'm going to jump right into the goodies, and we'll review track records and trade alerts at the end. But as you know, we're having a killer beginning to the month. All right, so yesterday, NRG went up a little higher from where we sold it. But I want you to see, since we made the trade alert Friday, and let's see if I can go back to that. Since we made the rotation out of NRGU into BOIL, NRG is now up 12% and BOIL's up 32%. Fantastic. That is our new inflationary hedge. We'll cover that in more detail, but just wanted to little brag for ourselves, pat on the back. All right, let's start off looking at the market data on reverse repo. This is our signal to get worried about growth assets. This is a quantitative easing buffering. And as long as it's above $1 trillion, we're really safe. Once it goes below 700 billion, I'm going to get worried that interest rates are ready to rise and most likely are already rising. So far, no reason to sell your tech positions. As you know, we're overweight tech relative to value with a ratio of 2-to-1 in the high risk strategy. Our new inflationary hedge is kicking butt. Most likely we will sell this based on seasonality towards the end of February, but if it just goes way too high, way too fast, we won't be too greedy. Natural gas is certainly not my expertise. I just saw the trends in lumber futures, copper futures, all sorts of futures, and we expected BOIL to perform significantly better than NRGU. And boy, oh boy, it is thus far. All right, in this chart, we're comparing NRGU, which is oil. We'll be back to oil. Oil's the king. We'll be back to oil soon. Don't worry. Next big pullback, we will jump on that train. Interest rates in yellow, banks in red, and the NASDAQ in the candlestick. And so in the very short term, you're getting all three to go up together. So beautiful, beautiful, beautiful for our portfolio. It's really when the interest rates go straight up that you get this sell-off in tech, but you get hedged with your energy play. So this chart, we're now looking at emerging markets interest rates, and then we're slicing a piece of emerging markets out with FXI and MCHI, which are two ETFs that target various sectors of China. FXI more large cap, MCHI more broad-based with tech. And so we can see there's a high correlation to interest rates and emerging markets. And essentially, since the interest rates have been falling, emerging markets have been falling. But now that paradigm is starting to change, and we're starting to get that really nice performance. In fact, look at this. Since the 13th of December, we can see the China-specific indexes are catching up to the returns of the emerging market and tracking those interest rates. So very, very good. We also want the dollar to fall. I'm expecting the DXY to fall to 90, and for emerging markets to scream up and outperform all other indexes in the near term. So that's starting to play out for the safe growth strategy. Here we're looking at IWM, the Russell 2000. This is Stanley Druckenmiller's famous indicator to predict markets. It's been giving us no signal for a year, trading sideways. Now, the caveat I would put to that is that it's holding up sideways with interest rates falling. To me, that's a very bullish signal, and I remain with the impression that the rates will rise over time. The stock market is going higher, and the IWM will soon break out of this trend. So we're keeping a close eye on it. And I think the main catalyst to this will be essentially passing more stimulus, which very well likely could be some more checks to the voter base. And we're seeing the Democrats pull all sorts of funny things. We got McConnell having a literal fit on TV today about playing with the election laws, and now they're still stuck trying to get this new stimulus passed. So they'll probably need the CPI to stop rising for Joe Manchin to sign on it. And they're probably going to have to throw in some free money to everybody, I believe, to get the Republicans on board too. So very bullish catalyst when that comes up, and it will make interest rates rise. Until then, boy, oh boy, these growth assets could really do well if yields just stay put or fall from where they are. And they last week had the largest move to the downside in history. It was ranked the 5th largest decline in a week, which is why I was believing we'd have a reversion, and didn't make any changes, which paid off handsomely by doing nothing. Okay, the European index trades a lot like the Russell 2000. You can see it's almost the exact same chart. Rates are going down. It's held strong. Bullish signal to me. Wait for those rates to go up, and remember, the Build Back Better stimulus will be the catalyst to drive that. All right, here we have DXY, and every time the dollar goes down, we rack up historic returns for our portfolio. And boom, there you go. It was way overbought on the RSI, and it's selling off. Lynn Alden has a good little clip about this, saying typically when you get this overbought on the dollar, and when it retraces, it can go about 10 points lower. That would put us at 87. I don't have the balls to hold you long all these positions to 87. But I'll tell you what, if we get to 90 on DXY, you guys are going to be some very, very happy campers with how we're currently positioned. And so almost comical listening to all these people talk about how the dollar is just going to go straight up over the last few months. And that's what people tend to do. They tend to follow the momentum. whatever the momentum's doing, it's going to do indefinitely, and it's a formula to blow out because you end up going all in on one trade. It works until you get blown up. We'll never do that for your portfolio with our strategies. As you can see, we're playing all the main strategies combined in a rock solid portfolio where each position protects the other. As far as long-term expectations, the dollar could break below 90. If I zoom out enough, we can see some levels where it has been. So, just in 2011, it was as low as 72. So just to put some perspective into just how low that could go. Now you put the dollar down at 74, you're going to be dealing with oil well above 120, Bitcoin probably in the 200,000s. So most likely the Fed will hike the crap out of interest rates if we go below 90. Now, if the dollar's up towards 100, they're going to have to do the opposite. They're going to have to weaken the dollar and do quantitative easing. So very good. There's that move down on the dollar, and we're starting to see the profits pile in for portfolio. Okay, Turkish Lira was causing some problems. The interest rate on their bonds are at 20% today, tied with a record high. And so that could potentially be a fun trade if there's an easy ETF for it to bet that their bond yields will fall. So taking a look at that, that could be a bonus trade for the high risk strategy. We'll have to just keep a close eye on that. Okay, the Chinese currency remains strong. The expectation is they're going to start to print money and weaken their currency and drive emerging markets screaming higher. So we're starting to see that play out. And as far as a massive devaluation that's out of control due to the real estate market popping, not so much the case. Bank of America came out with a report saying the best trade of the year would be to go long Chinese home builders and short US home builders, as we're going to tighten monetary policy, drive rates higher, which is typically negative to housing. While China is going to do the opposite. They're going to lower rates, print money, and bail out their housing sector. That trade apparently is already getting overcrowded from that news article. We're not in that position, but just interesting commentary. All right, this is one of the reasons why I was so confident to go aggressive in natural gas. Lumber futures have been predicting energy markets months in advance. Now, I ignored the signal in the summer when lumber futures fell, and sure as shit, oil fell soon after. I held through it, believing that the inflation was coming. It was just a matter of time, and that paid off very handsomely for investors. But now I'm not giving now we're not discounting what lumber futures are telling us. What we were seeing was this very sharp recovery. It's already half the way back up to the recent top. And that, along with oil remaining strong, gave me a high conviction that natural gas prices would soon follow suit. And that is exactly what we're starting to see here. So very good. And so far, no reason to get out. Now, I think if we see the 2-year yield start to fall or the lumber futures start to fall, that'll be our signal that energy prices are going to top out. So far, neither of those are happening. All right, let's look at some of these tech giants that are carrying the entire global stock market higher. Tesla, Nvidia, Apple, Microsoft, Google, Amazon, Facebook. Shoot, let's throw Netflix on there. It's another good one. So again, no serious pain in any of these funds. So yeah, no reason to freak out with anything we're long. Now we are starting to see some rotation action into some of the large cap S&P 500 companies, and we're tracking that in this chart. And some of the benefactors that we're seeing are not Pfizer in the recent. Pfizer is going to double its sales on that medicine that's so popular. So I'm not sure why it's selling off. Maybe people are starting to think we're going to have natural immunity, perhaps. But some of the bigger winners are Visa's down 13%. Bank of America's up 5%. Procter Gamble's up 3%. Let me go to this. This is where we're actually starting to see the rotation begin. Okay, so if we zoom in here, we're seeing the biggest returns on Berkshire Hathaway up 21%. Visa up 10, Bank of America up 10, Procter Gamble up 12, Johnson & Johnson up 9, United Health 13. So we're starting to see the rotation from growth to value, and it's going to be very, very slow motion. Now, in the most recent couple days, we've seen those rates fall, and we've seen the big jump back in tech. All right, now over in Asia, we are tracking 3 companies to try to look for problems before they may occur. Taiwan Semiconductors, holding strong. More notably and important is to see the rebound in Alibaba and Tencent. These are 2 national champions from China. Alibaba is now up 19% since December 22nd, and Tencent's up 14. So that is the signal we're looking for. And we did increase exposure dramatically last Friday. That trade alert's paying off. Now, if you listened to Jeffrey Gundlach's Total Return webinar yesterday, it was excellent. He was, well, he's saying he won't spend any money on China, but he thinks emerging markets is going to be a historic return in the coming years, and was waiting for the right signals to bet big on it. And boy, oh boy, that looks like the right signal to me. So we're in early before Mr. Gundlach, who manages $135 billion. He spent most of the webinar looking at the yield curve spreads, which we will definitely take a look at. He's actually recommending to protect your portfolio with treasuries, funny enough, on the long end, expecting that the Fed's going to break something with aggressive rate hikes. So we'll see it. We'll believe it when we see it. At this point, I think we'll make a lot more money betting yields go down via Ethereum or the NASDAQ, and that it's far too early to get so bearish that the market's going to get cracked in half from a 25 basis point rate hike that hasn't even happened and is scheduled maybe for March. All right, in this, we're looking at Toyota and AstraZeneca out of the European index. This index is highly diversified. There's no large positions that are anywhere near the size of the other companies we were looking at, like Apple or Taiwan Semiconductors or Alibaba. But their leaders, again, are looking very strong as well. Now, this is the key company to track for predicting NRGU. And so when it hit the upper levels of this Fibonacci level, that was really one of the reasons why we took profits. We're also almost at record oil prices over the last 12 months and rotated into a cheaper energy product, natural gas. And so far that's played off. As far as where I think NRGU is going, I believe most likely, unless there's some sort of 1984 Orwellian crazy climate change related lockdowns globally that crushes energy demand, I believe Exxon's headed to new highs over the next several years, and will break that high of 2014 where it touched 100. Potentially could blow past that. This would take NRGU significantly higher. We're talking in the $400 to $900 range, depending on just how high this goes. So we're going to wait for a nice pullback and buy that dip. So we'll likely sell BOIL, and then there'll be a period where we wait for a pullback to get back in. Unless NRGU pulls back as BOIL hits a peak price. So we'll have to play that by ear. But just remember, NRGU is a leveraged 3-time product playing the top 10 US oil companies. So if you're looking at technical analysis, the leverage makes it look really funky. Pull up your Exxon chart if you want to do any kind of technical analysis on that plate, which we're out of for the short term. All right, here's the U.S. oil prices. Boy, oh boy, it keeps going up. Our basic thought process. No. Our basic thought process was that if oil can trade flat or go higher, that likely natural gas would go significantly higher. And boy, oh boy, so far that has played out. Now we're starting to see those interest rates fall. If we do see interest rates fall, especially on the 2-year or the lumber futures, I'll likely start to take profits on oil. So keeping a close eye on that. But we do have these two starting to move very closely together. Again, interest rates in yellow and the candlestick in for oil prices. And we're getting back to a pretty heavy duty level that we last saw in October. Copper futures jumped higher. I was telling you I thought those would jump higher. We're not currently playing copper, but that's another futures market. We got China getting aggressive with expanding their economy now, and they're the main driver of copper prices. So that's what we expected. Baltic Dry Index is not turning over yet. This is one that I would expect to bottom out here and then continue up higher like lumber futures. And so far that's not doing what we've anticipated, but it's still at very high levels. All right, here are the interest rates that we're tracking. And now here's what I want you to note. So the 10-year and the 30-year were quite literally falling as the 2-year went higher. And we call this a flattening of the yield curve. Predicts a recession that'll be caused by the inflation, essentially. So you've got the inflation in the economy, but you don't have the growth. Now what we're starting to see is 2 years still going up, no relent, but we're starting to see the long end rise. We're currently positioned for that long end to rise and for a healthy-ish recovery coming through. And I think the Build Back Better bill will help reinforce the yield curve to be bullish in the way that we're positioned. So what do we really want to make from this? One, if we see the long end falling and the front end rising, that's bad news. That's signaling problems ahead. If we see all three rising, we're perfect, no changes. If we see that 2-year start to collapse, that's going to likely predict that energy prices are going to top out in the short term. So that's what I make of this data, and we'll cover it every Monday, Wednesday, Friday for you. Okay, TLT we were predicting would bottom out. It hit a resistance level right here, nowhere near where we saw the real pain last March. Now, the timing on that was passing 3 trillion in spending. So again, we did right here in December, Trump did $1 trillion deal, and then Biden came in with a $2 trillion deal. And that's what really drove these rates lower. Now, again, it bottomed out and we started to see signals. This time we actually saw oil crash and we realized, okay, this is going to stop. And we didn't make any changes in our growth position, did very well. And so that's what I'm thinking in the short term, that we're going to see these yields trade flat or fall, which means TLT goes up, and you're going to have great performance in your tech stocks and cryptocurrencies, and that the catalyst that will really be negative towards the TLT will quite likely be the passage of the Build Back Better bill. So that probably isn't going to pass until, I believe, March at this point, because we're going to need some signs that the inflation is peaking out and the economy is starting to slow, and that they really need to pass some more spending. Karen says, why do you think they're going to pass the bill? I wouldn't bet against politicians spending money. That's what I've learned. It's especially when you have half the Republicans in the pocket of the Democrats. Kevin says, what event will cause crypto to go higher? All you need for crypto to go higher is TLT to trade flat. And it is, and crypto is going higher. Steven says, isn't the Fed supposed to be independent? Why would they want to protect the Democrats? Yeah, it's not independent. Supposed to be, but I think they're all, once you realize they're all corrupt, and they're all in on it together, and their main goal is to spend as much money as they possibly can, and then this job gets a lot easier. And you can leave all the feelings to the side. Okay, Tesla was giving us a prediction that Ethereum would bounce. And sure enough, it did. So far, that leading indicator of Tesla is proving to be valuable to us for our very large Ethereum position, and also predicting rates. So very good on that indicator. Silver and gold getting a little bounce. Peter Schiff is super excited, I'm sure. We got some tweets from him today. He's a character. I like listening to him. There was a interesting debate between Brent Johnson, the milkshake dollar dude, and Peter Schiff. It was a decent listen if you're on YouTube. Okay, on this chart, we're looking at our deflationary bets. If we think the Fed is going to actually fight inflation and get super aggressive and crash everything, I like 3 products: UVXY, that's put options on the S&P 500. I like treasuries. I'd really like treasuries if McConnell hadn't increased the debt ceiling by $2.5 trillion. So that's one reason why I think treasuries have a lot more room to fall once we agree on how to spend that $2.5 trillion. And then I like the good old-fashioned dollar, which is trading the dollar against the euro with EUO. Right now, all I dare play for defense or deflation is the VIX, which is really cheap, extremely cheap, and a great buy and a great hedge. That's all we need currently. So if I really had high conviction we're going to crash the stock market, then I wouldn't want to be all in on the VIX. It's too risky. I would get us primarily in the dollar, largest position. Second largest position would be TMF for treasuries. And then the third largest position would be UVXY. Potential return for UVXY is over 1,000%, maybe 2,000% if you get the right crash. Treasuries could gain a couple 100% with the leverage in TMF, and the EUO could go up maybe 20 to 30%. And then we would keep some hedges in place in case the crash didn't occur, which would most likely be, well, we'll play that when we get there. It'd probably be the triple Q and NRGU around 20%, and 80% in the super defensive. And that'd be if I was extremely confident that they're going to crash us. Now, what would make them want to crash it? The inflation goes up, up, up way too fast, and they have no choice. So far, that's not my expectation. I believe we've probably seen the hottest print on the CPI, maybe this print, maybe in the next 2, and then it's going to come back down. If that's the case, the market's going to get very bullish and expect that the Fed's not going to be as aggressive as they're currently threatening, which is really not that aggressive in the first place. All right, in this chart, we've got a bunch of different littler plays that we could consider in the future. Energy related, oil kicking butt, dominating, copper, COPEX doing well. We do have rare earth metals and RAMX and uranium in the safe growth strategy. Love those plays long term. Corn, KRB, so that's just agriculture. Expecting those to go up this year. Not sure if that's the right play for us after we get out of oil. KRBN are carbon credits. I like that play unless we have a huge sweep of the House and Senate. Then I'm not so sure it's going to be as attractive. But they're changing election laws or talking about it by removing the filibuster. That could be a game changer. So who knows? You know, who knows? We'll have to follow that much more closely. And then we've got Cow, DBA, more agriculture. MJ just been a complete dud. And then TAN is really an aggressive version of emerging markets. That could potentially be our new high risk fourth position after this huge sell off all year. So we'll worry about that when the time comes. All right, we're getting a boost in the crypto space after flirting with a lot of dangerous technical levels. So we're long Bitcoin in the safe growth and we're long Ethereum in the high risk. I like both a lot. Ethereum's getting ready to switch to proof of stake. The founder says they're about 50% of the way there to make that rollout. I was doing a bunch of trading today and the trades are costing over $100. Smart contracts are costing $300 to $400. Now, what I was doing is setting up to generate profits from all those ridiculous fees. So I love it for my investors in that private equity offering. But boy, oh boy, just when you think of the grand scheme of things, that's insanely expensive. But this new move should reduce those costs dramatically, perhaps by 50 to 80%. So that should make the network much more efficient and provide a lot more value long term. Gold copper ratio will jump up after this data comes in. It's a little bit delayed, but just to put into perspective, the period I believe we're going to be following is 2002 to 2008. And you can see how copper outperformed gold for so long as interest rates rose. And that's exactly what I'm anticipating is coming down the pipeline, unless something really slows down energy demand. Okay, it's almost certain now that we will have a rate hike to 25 basis points starting in March, and that the quantitative easing will end. So that is what we're currently prepared for. I believe this is already priced into the market. Perhaps all 4 rate hikes of this year are already priced in. So if growth slows, inflation stops rising, quite likely people could recalibrate, less rate hikes, lower interest rates, and a huge crypto boom. On the other hand, you get too much inflation, we're going to get the exact opposite. So the next few months of inflation data is very important. All right, let's look at the yield curve. So most of Jeffrey Gundlach's entire presentation was looking at this. Now he was looking at the spreads of the 2-year, he was looking at the 1 month against the 1 year, the 2-year against the 5-year, the 5-year against the 30-year. And basically he thinks the Fed's going to hike until they slow down the economy and create a crash, and that you should think about getting into treasuries soon, as well as emerging markets. So it's an interesting webinar. So what's he talking about? So this is sloping like a hill. That's the exact opposite of what the Fed wants. They want it to be sloping like a ramp. And so what's notably happened over the last 3 months is the 2-year is rising rapidly, and the long end had been staying flat. Now, we just got it to jump last week as it crashed 10%. But in general, they really want this to look like, I'll show you what a good slanted one looks like. Funny enough, right before Trump did $1 trillion in stimulus, we had the right shape. So that's closer to the way it should look. So again, if we see the 2-year keep rising and the long end falling, the bond market's predicting the Fed's going to make a policy mistake and crash markets. If the 2-year starts to fall and the long end's rising, that's really what their goals are in the short term. So yeah, we got a very ugly yield curve, just to really summarize it. Now, from our point of view, for short-term reaction, if we see the 2-year start to crash lower, we're going to expect we should sell our energy play. And that's going to be our primary signal for that. If we see the long end rising rapidly, we want to sell the growth assets if we believe that's going to occur. So 2 different signals for us. All right, here's the VIX futures month by month. And we can see the most hedgings occurring in January and February by measuring the distance between these dots. And that's because we have inflation risk, Federal Reserve policy mistake risk, and a fiscal cliff coming fast by March. So they really need to pass that spending probably before April 1st. Okay, there's that rebound in cryptos. Let's see which one's having the best return. I got Polygon jumping 19%, Polkadot 14, Binance 13, AVAX 13, Ethereum 10, Cardano 10, Solana 7, Bitcoin 5. Okay, we're starting to see cases in the UK fall, which we expected. It's basically over with in South Africa, where this variant came from, and I believe US has now peaked. So this will likely come on down, and then the labor can come back online. So we'll see how strong labor is. Maybe February will be a decent print, in March even better. Here's the rate of change of cases falling. We predicted this would hit a new high. Came all at once. Boy, oh boy, did it. Now it's falling, and we believe it will continue to fall. Okay, we're starting to issue debt, but as long as reverse repos at 1.5 trillion, we don't care about that. PPI, we really need to see PPI stop going up. It traded flat for 3 months, then jumped to 9.6. So quite easy to predict that the CPI would follow, and it sure did. So it jumped from 4.9 to 5.5, and the PCE 7. So we really want to see the jump month over month be less than 0.6 in the coming months, showing that the rate of change is slowing down. So could quite likely go a little bit higher for the next 3 months, as long as the jump is relatively less. Then I think that's going to be all the bond market needs to not freak out and crash and cause those problems. But if this jumps to 6.1 next month, that's not going to be good. I would not be surprised if we get a 6.1 that the bond market sells off and then causes tech stocks to sell off. So that's what we want to see. Maybe jumps to 5.8, market would probably like that, but if it goes to 6.1 or higher, I think that'll be very problematic, because it would show us that the inflation is not slowing down at all. Okay, jobless claims still at low levels, labor force very low relative to lockdown days. Starting to come up, so it is rising. Tons of oh, this is bank credit. So as the government's going to spend less, we do need to see lending occurring to keep the economy strong. And that lending is very robust and rising rapidly. You can see the rate of change is actually accelerating. Very good for how we're positioned. Consumer credit growing, which makes sense. Retail still growing in terms of spending, consumer spending. Rate of change slowing down, but a new high. With share buybacks, this doesn't have to necessarily go up every month to have a strong stock market, as long as rates aren't rising. And this is elevated, and we got share buybacks. We can definitely see stocks go higher. Balance, trade balance, highly negative, very important for how we're positioned. And I don't think that's going to change unless we get a very populist government in control, probably of all 3 branches of government, to be able to pull off any considerable policy changes. So maybe 2024, big maybe, we'll see. China's PMI is starting to recover. Their imports are at record highs. Exports are at record highs. European PMI is slowing. Fed's balance sheet is going to likely top out at 9 trillion. And end in March. And then they're talking about letting some of the debt roll off so that it would start to shrink. It'd be slow. Europe's balance sheet flat month over month. Japan's down slightly. Let's go check out the news. Daniel Lacalle says, U.S., what inflation shows is that essential and non-replaceable goods and services are rising at a much higher rate than 7%. Real wages and income are getting obliterated, printing a $1 trillion spending insanity. Okay, Biden and Democrats talking about changing voting laws. And McConnell's pissed. This could be important on midterm, so keeping a close eye on it. Rumors are now Hillary Clinton versus Trump for 2024. Drudge reports testing that idea out on their homepage today. Small businesses are raising wages, especially for the younger group, but we're starting to see older groups get a raise now too. Rick Rader of BlackRock believes the Fed will raise rates, and this Albert fellow I follow believes that there will have to be a stimulus added to the Build Back Better to pass this. He's pretty good at predicting politics. Lynn Alden, over the past 20 years, when the dollar index RSI is over 70, overbought, and then rolled over into negative momentum, that is usually presaged a rather persistent bearish move in the dollar from that point. And here you can see the RSI doing just that, going above the moving average, rolling over, usually down around 10 points or so from there. I don't think it will go 10 because that'd put us at 87. But if DXY goes to 90, I'll be taking profits for short term on all our inflationary bets. Okay, here's that cartoon I promised you. So 20 to 30% year over year inflation. You can see the cops trying to bust down the door. And then the Fed's response is a 25 basis point hike. And that's as strong as a Cheeto to stop the inflation. So they're just joking that the Fed's gonna have to do much more. In the past, in the 70s, we actually had to hike the interest rates to above the CPI to crush it in that era. In recent eras, simply raising the interest rates long enough, even when it was below the inflation, did the trick. And I don't think we'll have to go anywhere near that to crash markets in this day and age because the level of debt is dramatically higher. So that's the reason why. Okay, so a lot of hysteria over the voting laws being changed. I'll cover that as it develops. Zero hedge jokes. Last time inflation was here, ET phoned home. Okay, Jim Bianco is saying that the inflation is hurting 40% of the public that has less than $1,000 in savings, and that this is now crushing his political approval rating, which is very, very low, and that we're getting Jimmy Carter-like pressure to the Federal Reserve to hike interest rates because confidence is dwindling in the American population. So the political pressure is now more aggressive to hike rates. So we got to keep that in mind and hope that this inflation slows down. Otherwise, we have to respond. Powell now says inflation will stay high until mid-2022. We got some Bloomberg chart saying to be back to 2% by year end. I don't think that's, I'd expect it to stay above 4 unless the Fed crushes the economy and puts us in a recession. So either way, it's not so hot for midterms. Now, the inflation is definitely being miscalculated. A lot of people have a lot of data on that, but just rent alone is up more like 15%, and they're saying it's only 3.8. Some JP Morgan quotes: nothing inherently valuable underpins the Bitcoin network, similar to the world's fiat currencies, since leaving the gold standard, except for perhaps the military and all the tax revenues. In our opinion, Bitcoin is particularly well designed as a modern store of value, and the strong design has contributed to the increased confidence in and value of Bitcoin. ARK down 50, ARK's down considerably. Here's a look at what they hold. If you're looking for a better hedge on Bitcoin and you're looking for someone to sell a lot of a related asset, note that the ARK fund has 5% long Coinbase, $757 million worth. So if you got her capitulating and dumping, I do believe Coinbase is the best out of the money put option you can buy to protect crypto portfolio currently. Narrative's changing. I believe there's going to be less restrictive policy in the US. Bill Gates essentially saying that this will be treated like the flu. Okay, here's a good chart. We can actually wrap up with this one. So in this chart, we have the CPI versus the federal funds rate. So if we go back to the 70s, we can see they quite literally hiked the federal funds rate very close to the CPI to actually finally kill it by 1980. And all the way up till the 2000s, they did similar. But after the dot-com bust and the debt started piling up faster and faster, they haven't had to go so high to crash everything. So note in this period from 2004 to 2006, the inflation was way above the federal funds rate. And just by hiking it to here, you finally got a collapse. They kept it flat at this higher level, and then boom, the whole thing came falling apart when the housing bubble crashed. Next period, we had the higher CPI coming in, and way below where the CPI was, and it was crashing the stock market. So how high will they have to hike to pull it off this time? 4 times, 8 times, we will see. So that's where we need to focus for hedging. Okay, very good. Let's look at portfolio positioning now. All right, so the safe growth strategy clocking in at 7.7% return for January. High risk clocking in at 15.8. Up to 16. If you combine the two with a 70-30, you're up about 11.5. Let's look at the profile of each strategy. And don't forget, if you're not upgraded, you're going to miss out on this critical section where we reveal the exact asset allocation. You'll need to upgrade and take advantage of only 3 spots available by calling Dean at 505-322-7515.